Corporate Finance Core, Topic 1, Section 3. Compute and interpret accounting ratios of solvency, asset management, and profitability. So let's look at solvency ratios. Now, financial ratios combine financial statement line items to form common metrics for evaluation. Ratios provide little insight by themselves. However, if you look at trends, compare them to other firms, it becomes very useful. So let's look at these ratios of solvency. The risk that the organization cannot pay its bills. All right, so one way of thinking about this is short-term solvency versus long-term solvency. So short-term solvency is looking at current assets and current liabilities and saying, and sometimes it's saying as everything comes due, the payables come due and the receivables, you get the cash for them. Do you have, and you sell your inventory or don't sell your inventory, do you have enough cash in the short run to handle your current liabilities? Again, think of current liabilities as, say, taxes payable and accounts payable. So you have the current ratio, which is just simply from the balance sheet any given year, take current assets divided by current liabilities. So again, your current assets are going to include cash, cash equivalents, accounts receivable, inventory, other current assets. Current liabilities are going to include accounts payable, taxes payable, and other current liabilities. Or even a short-term portion of long-term debt will be in current liabilities. So if I just divide those numbers, in 2018, the firm had $1.60 of current asset for every dollar of current liability. So if that's greater than 1, these ratios, that means that current assets are greater than current liabilities. So that's good news. You have more current assets than current liabilities. However, some of the current assets, it wouldn't be easy to turn them into cash. So if I just take current assets minus inventory, so it's primarily accounts receivable and cash, and divide that by current liabilities, well, now I don't have enough coverage in 2018, but I did in 2019. Again, greater than 1, meaning it's your current asset minus inventory is greater than current liability. However, inventory is not so easy in, say, economic downturns to turn inventory into cash. So if I just take cash, the only line item from my current assets divided by current liability, I only have coverage of 30 to 40% of my current liabilities. In other words, I have 30 cents in cash for every current liability in 2018. So again, these are short-term solvency. Do I have enough current assets or cash to pay off current liabilities? Long-term solvency comes down to 2 types of measures. Leverage measures, in other words, how much debt have you used in your organization, and then interest coverage. Will I be able to pay off interest in a given year? So let's look at the leverage measures. First is the liability equity ratio. Just take total liabilities divided by total equity, and I got a number here of 1.4. So for every dollar of equity, I have $1.40 of liabilities. So it looks like I'm using more liabilities than equity in financing. So that's a measure of risk. I'm using more liabilities. And then I can just focus, instead of all liabilities, I can just look at debt. Just take debt over equity. And that's just to give me another measure of leverage, use of debt in financing. I could look at net debt over equity. Net debt is used often in finance and accounting. Just take debt minus cash. So if I have, say, $100 in debt, but I have $10 in cash, what I might say is I have $90 in net debt. My net exposure, I could easily pay off on $10 of that debt. So if I just look at net debt over equity, it may be a better measure of leverage if you're holding a lot of cash. And then the last one is take assets over equity. So for every dollar of equity, you have $2.4 of assets. So again, that's another measure of leverage. I'm not financing all of my assets with equity. So all of these kind of get at the same idea of how much liability or debt was used in the financing relative to equity or in total. And then these last 3 measures are am I going to be able to pay off my interest? Otherwise, I am technically in bankruptcy if I can't pay off my interest. So I can do times interest earned. So I can take my interest or my EBIT in any given year divided by the interest in that year. So for this organization, for every dollar of interest, they had $4.6 of EBIT. That's a very good number. That tells me I have plenty of EBIT to cover my interest. In other words, a lot of operational profits. Well, EBIT's a little more than that because it includes depreciation. And then I can have another measure of EBITDA over interest, so an EBITDA interest coverage ratio. So again, EBITDA is kind of your first measure of profitability, earnings before interest, taxes, depreciation, amortization. So that looks really good. And then you can also have a cash coverage ratio. So this combines a balance sheet item cash and an income statement item interest, just like these do. And it's just looking at cash over interest. I had, for every dollar of interest expense, I had $3.50 of cash, which is very good. So short-term solvency, I want those numbers to be high. I have leverage ratios, which for risk, you want those numbers to be low. And I have times interest earned, or these interest coverage ratios, you want those to be high to show that you have plenty of money or cash flows coming in to pay off your interest expense. Then you have ratios of asset management and profitability. So asset management ratios are really talking about how efficient the organization is in use of its assets. So I can have inventory turnover, so cost of goods sold divided by inventory. So for that period of time, 2019, my cost of goods sold were 6 times the level of inventory. So it gives me a measure of how often I'm turning over that inventory into sales. I can take 365 days divided by the inventory turnover. We just calculate it, and that gives me an idea of the average days my inventory was in inventory. So it looks like on average I had 59 days of goods sitting in inventory before they're sold. I can also have receivable turnover, just like inventory turnover. I can take sales over accounts receivable, and when I take 1 over that, 365 divided by that, it looks like the average receivable is out for 47 days before it's paid. And then I have total asset turnover. I need $1 of assets to generate $1.20 of sales. So obviously the higher the ratio of sales to asset, the better. That means you need less CapEx, less expenditures to generate some level of sales. So this is how effective the organization is using its assets. And now profitability measures. So I got net profit, or just the profit margin, total net income over sales. So for every $100 of sales, you generate $3.80 of net income. You got EBITDA over sales. So again, it's for every $100 of sales, you have $12.4 of EBITDA, or kind of operating profits. And then you have ROA, return on asset, net income over my asset value, total assets. So it gives me a measure of how effectively I turn assets into profit, and then net income over equity, how effective am I turning equity investments or financing into profit. And the ROE is going to be greater than ROA, because to the extent that you finance some assets with debt, you're going to generate some level of net income, you're going to have higher ROE than ROA because of leverage. One way, it's an interesting analysis of financial statements, is to decompose ROE. If you think about the ultimate measure, if you're of a firm, if a firm's is going to be measured about how much they're able to generate profit for their shareholders, ROE would be a good measure to look at, net income over total equity. So in this year, this company's ROE went from 11 to 10.7. That was a drop in by 0.4%. So that's a bad thing. So we can decompose ROE to be the product of 3 other ratios. So if I take my asset turnover ratio times my net profit margin times my equity multiplier, notice asset turnover, sales over asset, net profit margin, net income over sales, equity multiplier, asset over equity. Notice how what cancels out here. So if I multiply these three numbers, what it gives me is net income over equity, which is ROE. So from 2018 to 2019, the ROE went from 11 to 10.7. I did that by, I can either just divide net income divided by equity, or I can also just do it as the product of these three ratios. So why did ROEs fall? Because asset turnover fell. I did the organization did a poorer job of turning assets into sales. However, for every dollar of sales, I actually generated more profitability. So maybe the problem has to be the problem so far is the ability to generate sales, because at a given level of sales, I'm actually more profitable. However, what's killing it looks like, well, these two items are really hurting, is the equity multiplier fell. So I'm actually I have less leverage. This shouldn't be a percentage, this is the percent change right here. I have less leverage. That is hurting my ROE. Now that's a little bit of a trade-off. All else equal, I always want higher asset turnover. I always want higher profit margins. However, when I have less of an equity multiplier, it's hurting my ROE because I'm using less debt. So that's going to be the trade-off there. So why did this organization's ROE go from 11 to 10.7? Well, they're doing a poor job or a worse job of generating sales for a given level of assets. So maybe you can do a deep dive and see if that was inventory maybe. And also however, the profit margin's increasing. That's good news. However, the mixed news is I have less risk, but that's hurting my ROE. Now, problems with financial ratio analysis. There's no way to tell you which ratios are the most relevant. So every organization has their key ratios, whether it's a key ratio of solvency or a key ratio of profitability. Also, firms use varying accounting procedures for revenue and cost recognition. So even comparing across firms is sometimes has some trouble. Firms have different fiscal years. So think about year 2020 with the COVID. So COVID hit around March, really shutting down economies in March, April, May. Different companies have different fiscal years. In other words, what a company calls the year 2020, it may be January to January, or January through December, or maybe it starts in March. So you really can't always just look at fiscal years and say, well, this firm's doing better or worse. Well, one firm may have started the fiscal year 3 months later than another. And again, fiscal year is just what is the time period for 1 year. Now, a lot of firms don't use fiscal years equal to a calendar year. So think of a calendar year, from 1/1 to 12/31. Now, one reason a lot of firms would choose a fiscal year of, say, 3/1 to the following year. Why would you do something differently? Why would you start in March? Well, you can think of it as a selling season. If a company is in a cyclical and sells a lot of goods during the final period of the year because of holiday sales, and then maybe have a lot of returns in January and February, maybe you'd like to consider a year going from, say, March to March, because that's really how well you sell your goods and net of returns. So there is a difference between fiscal years versus calendar years. And if you just see 2018 for two organizations or 2020, you may miss what's going on. There also might be extraordinary one-time events that affect one company. Maybe they purchased a business 5 years ago and then had to sell it this year at a loss. Everyone knew it was doing poorly, however, in this year it hit the actual financial statements. So you have this extraordinary one-time event. That's why a lot of people like to look at numbers like EBITDA, which would exclude those one-time charges, which might be in net income. Also, globalization makes difficult for comparison because of different accounting rules. And also, financial statements are not based on market values. So an organization may have gotten a lot richer because their real estate holdings are increasing in value, but that's not hitting income statement because there's no sale of a good. Here's a fun little quote. Financial statements are like perfume, to be sniffed and not swallowed. So what that's saying is you look at the ratios, you try to get some information, but you understand that there's a lot of differences and you can't just make broad statements about the health of the organization or a comparison of two just based on the financials alone or one financial. So on this topic, we computed and interpreted accounting ratios of solvency, asset management, and profitability. In the next topic, we'll start using Excel to make some computations in our financial statements.